every amateur trader was losing their shirts in the 1907 panic, one man walked away with over $3 million in profit, roughly $100 million in today's money. His name was Jesse Livermore, and what he did that October went against every screaming instinct in his brain. When banks collapsed and fortunes evaporated overnight, Livermore didn't just survive the chaos, he systematically harvested it. But his success wasn't luck, intuition, or insider information. It was something far more systematic and infinitely more repeatable. Here's the brutal truth most traders refuse to accept. Panics don't take your money. Your reactions do. The amateurs in 1907 thought they were buying the dip. They saw falling prices as opportunity. They believed in fundamentals over price action. They trusted hope over evidence. The professionals like Livermore were doing something completely different, something that separated the 5% who profit from crashes from the 95% who get wiped out. They understood that market panics aren't random events. They're systematic wealth transfers from the unprepared to the disciplined. You see, there's a counterintuitive promise hiding in market chaos. Doing nothing, at the right time, can be your most profitable trade. Most traders think panic selling is irrational. They're wrong. Panic selling is the market showing you its line of least resistance. It's smart money, exiting before retail investors realize what's happening. Amateurs fight this force. They buy dips that keep dipping. They average down into accelerating losses. They confuse stubbornness with conviction. Professionals ride this force like a surgeon with a scalpel, precise, calculated, and without emotion. But here's where it gets interesting. The same tape patterns that played out in 1907 have repeated in every major crash since 1929, 1987, 2008, 2020. The technology changes, but human nature and market structure remain identical. Fear and greed drive the same behaviors. Leverage amplifies the same mistakes. Distribution patterns look identical, whether you're reading ticker tape or digital charts. Livermore understood that waiting as a position isn't passive, it's the most active thing you can do. While amateurs chase every wiggle, professionals wait for their setup. Consider what happened on the old curb exchange. A young clerk sees United Copper unravel and thinks, it can't go lower. He buys with no plan, no stop loss, hoping for a miracle bounce. Each downtick tightens his throat. Each uptick forgives his lack of discipline and locks him deeper into disaster. Across the room, an older operator watches the pivotal point test, sees volume surge on the breakdown, and waits for confirmation. When it prints, he sells short with small size, risks 0.5% of his account, and breathes easy. 2 hours later, he moves his stop to break even and lets the tape work. The difference isn't courage, it's protocol. Picture this. Union Pacific drops 15 points in 2 days. The amateur sees oversold conditions and thinks bargain. He calculates that the stock is trading below book value. He reasons that railroads are essential infrastructure. He convinces himself that smart money is wrong. The professional sees distribution, smart money exiting before the real damage begins. He watches volume patterns. He identifies key support levels. He waits for confirmation of the breakdown. He doesn't fight the tape. He reads it. Price is the judge. Volume is the jury. Your discipline is the sentence. This isn't poetry. It's the fundamental reality of market structure. Price tells you what's happening. Volume tells you how significant it is. Your discipline determines whether you profit from this information or get destroyed by ignoring it. Amateurs argue with price. Professionals accept its verdict and position accordingly. The 1907 panic taught Livermore lessons that modern traders still haven't learned. Market crashes aren't black swan events, they're recurring features of market cycles. The biggest profits come from positioning before the crowd realizes what's happening. The same patterns that create panics also signal their exhaustion. Doing nothing is often the highest probability trade available. The market rewards patience and punishes impatience with mathematical precision. Livermore liked to say the big money is in the waiting, not the trading. Waiting as a position means you set your levels, define your risk, and do nothing until the market invites you. You promise yourself you will not average down, you will not widen stops, and you will not confuse movement with opportunity. Patience is the cheapest hedge on earth. You are not paid for activity, you are paid for alignment. When the market shows its least resistance path, your job is to follow, not argue. Trade smaller than your ego wants. Cut faster than your fear allows. Use numbers as anchors in the storm. Risk per trade under 1%. Stops above meaningful bounces. Exits into climaxes. You will forget theory under pressure. You will remember rules you've rehearsed. By the end of this breakdown, you'll understand Livermore's 3-step panic protocol. Trade only on confirmation. Build positions by pyramiding. And recognize pivotal points for exits. We'll close a loop most traders never notice. The same tape that sells off in despair telegraphs the turn. One bell rings twice. First, when the breakdown begins. Second, when the recovery starts. Both signals use identical principles. First question we'll answer: what exactly counts as confirmation when fear takes over? Amateurs act on headlines. Professionals act on confirmation. In panic, your first job isn't to be early, it's to be right. Livermore waited for the tape to crack pivotal points before he attacked. He called it reading the market's true intention through price action alone. While newspapers screamed about bank runs and corporate scandals, while rumors flew like sparks across trading floors, Livermore ignored every word. He watched bids and offers. He counted volume. He measured the distance between support tests. The tape never lied, but it demanded patience before revealing its secrets. Here's the core problem that destroys amateur traders. Panics, spray, fake breaks everywhere. A massive red candle looks convincing until it snaps back and destroys your account. Fear creates optical illusions. A 5% drop feels like confirmation when it's actually just noise. A volume spike might signal panic or simply reflect normal market making in volatile conditions. Without a systematic approach to confirmation, you're trading emotions, not probabilities. The market will punish emotional decisions with mathematical precision. Walk through the Knickerbocker Trust tape with me. News screams liquidity crisis throughout the morning session. Rumors fly about bank runs and depositor panic. The amateur sees the gap down and thinks, easy money. He enters at market open with no plan, no stop loss, maximum position size. 3 hours later, he's stopped out on a vicious squeeze as short covering ignites a temporary rally. His account is lighter, his confidence shattered, and he's learned nothing about reading market structure. The professional sees something completely different. The stock holds 28.23 times over 2 hours. Each test brings slightly less volume. The bounces reach 29.1, then 28.95, then 28.8, each recovery weaker than the last. This is a pivotal point under systematic attack. Defensive buyers are getting exhausted. Smart money is methodically distributing shares to retail investors who think they're buying bargains. On the fourth test of 28.2, something changes. The bids that defended this level simply vanish. No gradual erosion, they disappear instantly. Volume surges 200% above the 5-minute average. The bid-ask spread widens from 8 cents to 23 cents like a wound opening. Orders hit the market with urgency, not calculation. Prints scatter as if the floor tilted. That 28.2 level transforms from support into resistance. When 28.19 prints on power confirmation triggers. Protocol for panic confirmation begins with defining your pivotal point. The price level that held multiple times with obvious defense. This isn't arbitrary technical analysis. It's identifying where real money stood its ground. Look for at least 3 tests of the same level within a reasonable time frame. Watch for decreasing bounce strength after each test. Note the volume characteristics of each defense attempt. Demand a decisive break. Clean print through that level with volume at 150 to 200% of recent average. Half-hearted breaks don't count. Wicks and brief punctures aren't confirmation. You need sustained trade below the pivotal point with expanding volume. The break should feel violent, not tentative. Market makers should widen spreads. Bid support should evaporate completely. Require follow-through. At least 1 to 1.5% extension beyond the break before first entry. Confirmation isn't just breaking the level, it's proving the break has legs. Amateurs chase the first tick below support. Professionals wait for the market to prove its commitment to the new direction. This follow-through requirement filters out false breaks and increases your probability of catching meaningful moves. Place stop-loss above the last meaningful bounce, not a little bit, but definitively above. Your stop shouldn't be a prayer. It should be evidence that your thesis is wrong. If the market reclaims the pivotal point with authority, you want out immediately. Don't give failed trades room to become disasters. The stop level should be obvious from chart structure, not arbitrary percentages. Size small on first entry, 0.5 to 1% account risk maximum. Confirmation gives you permission to trade, not permission to bet the farm. Your first entry is reconnaissance, not invasion. You're testing whether the market will reward your patience with follow-through. If you're right, you'll have opportunities to add. If you're wrong, small size keeps damage manageable. Maxim. Confirmation is your entry fee, not your guarantee. Without it, you're gambling. The market doesn't owe you anything for waiting. Confirmation simply tilts probabilities in your favor. It reduces the likelihood of getting chopped up in false moves. It provides logical reference points for risk management. But it doesn't eliminate the possibility of being wrong. It just makes being wrong less expensive. Here's the twist that destroys amateur traders. You don't need the news. In 1907, rumors flew everywhere about which banks would fail next, which trusts were insolvent, which industrials would cut dividends. Livermore traded only what the tape told him. He understood that news follows price, not the other way around. By the time information reaches retail traders, institutional money has already positioned for it. The market votes with money, not opinions. Never anticipate, always confirm. After the 28.19 break, Knickerbocker Trust pushes to 27.85 within minutes. That's your follow-through. A timid bounce to 27.98 shows light volume and narrow bids. Sellers reload. You enter your first short near 27.9 with risk defined above 28.35. Your position size is small by design. Fear and greed want you large. Discipline keeps you humble. But confirmation is just permission to enter. The real edge comes from how you build your position as the market proves you right. Which brings us to Livermore's most counterintuitive rule about adding to winners. Big losses don't come from bad entries. They come from bad ads. Amateurs average down into pain. Professionals pyramid up into proof. In 1907, Livermore shorted weakness and added only as the market confirmed his thesis with accelerated selling. Each ad came with tighter risk control and smaller position size. He never averaged a loser. This single principle separated him from thousands of traders who blew up their accounts by throwing good money after bad positions. The market doesn't care about your average cost. It only cares about supply and demand at the current price. Here's the fundamental problem that destroys trading accounts. Panic volatility tempts you to get size on fast. That's greed disguised as urgency. When you see a stock cracking pivotal points and accelerating lower, every instinct screams to load up immediately. Your brain calculates potential profits on maximum position size. You imagine the bragging rights. You forget that the biggest moves often include violent counter-trend rallies that can wipe out over-leveraged positions in minutes. Walk through how the professional thinks differently using our Knickerbocker Trust example. You short the 28.2 break at 28.05 with 0.5% account risk. Your stop loss sits at 28.35, just above the last meaningful bounce. Your position size is deliberately small, perhaps 200 shares when you could afford 2,000. The stock flushes to 27.4 over 2 days as panic accelerates. You don't celebrate, you observe. This is where amateur and professional mindsets diverge completely. The amateur sees his small profit and kicks himself for not going bigger. He starts calculating what he could have made with larger size. He promises himself to be more aggressive next time. He's already planning his next trade based on greed, not confirmation. The professional watches tape behavior. Pullback stays shallow at 27.65. Volume remains heavy on down bars, light on bounces. Spreads stay wide. Bids remain thin. The tape says trend intact, but he doesn't add yet. Protocol for panic pyramiding starts with base risk per trade, 0.5 to 1% of total account. Professionals survive to trade tomorrow. Your first entry should be your smallest position unit. Risk to your stop loss above the last failed bounce. This isn't timidity, it's intelligence. You're testing the market's commitment to your thesis with money you can afford to lose completely. Add only on proof. When price takes out the most recent swing low by 0.75 to 1% with volume confirmation. In our example, the swing low sits at 27.4. You need to see 26.65 trade with expanding volume before considering your second add, not 27.35, not 27.2. You need decisive follow-through that proves sellers remain in control. Half measures get half results. Each add must be smaller than the last. 1, 0, R, base, then 0, 7, R, then 0, 5, R, never equal sizes. If your first position risked $500, your second add should risk $350, your third $250. This creates an inverted pyramid that maximizes profit while minimizing risk. Your largest position gets the best price. Your smallest additions test whether the trend continues. This structure protects you from violent reversals that can erase profits instantly. Trail stops to recent swing highs or move earlier units to break even as new adds go on. Never let a winner become a loser. When you add at 26.65, move your original 28.05 entry to break even at 28.05. Your second add gets stopped at the recent swing high of 27.65. This locks in profit on your best entry while giving new positions room to work. Risk management becomes dynamic, not static. Never add if your last add is underwater, that's hope, not confirmation. If your 26.65 add immediately moves against you, don't compound the error with another add. The market is telling you the trend might be exhausted. Listen to price action, not your ego. Hope is the enemy of profitable trading. Confirmation is your only reliable friend. Maxim: you earn size by being right. You keep it by moving stops. The market rewards accuracy, not aggression. Your position size should reflect your confidence level, which should reflect the strength of your confirmation. As the market proves your thesis correct, you earn the right to increase exposure, but you keep those profits only by managing risk systematically. Consider Northern Pacific's collapse from 127 to 85 inches 3 weeks during the 1907 panic. Amateurs saw a 33% discount and bought the dip. They reasoned that railroads were essential infrastructure. They calculated that the stock was trading below book value. They convinced themselves that smart money was wrong. Livermore saw confirmation of his short thesis and added near 85. The stock hit 65. His late addition still generated massive profits because he traded with the dominant force, not against it. This illustrates a crucial point about pyramiding. You don't need to catch the exact top or bottom. You need to catch the trend. Livermore's add at 85 came after a 33% decline, but the trend still had 23% more to give. His systematic approach to adding winners generated more profit than trying to time perfect entries. Pattern interrupt. Waiting is a position. If the tape hesitates, you hesitate. Not every breakdown continues immediately. Sometimes the market needs to digest selling before the next leg down. In our Knickerbocker Trust example, if volume dries up at 27.4 and the stock trades sideways for hours, you don't force additional adds. You wait for the next confirmation signal. Your second add triggers at 26.65 when the stock breaks 27.4 with expanding volume. Your third add comes at 26.15 when it takes out 26.9. Your blended stop now locks profit even if the next candle reverses violently. You've built a position systematically, with each add smaller than the last, each protected by trailing stops, but panics don't last forever. Forced selling eventually exhausts itself. Smart money begins accumulating shares from weak hands. Volume patterns change. Pivotal points shift from breakdown levels to potential reversal zones. How do you recognize when the dominant force shifts from selling to buying? Fear has a fingerprint. It's loud, sloppy, and accelerating. In 1907, when the market convulsed and bids vanished completely, J.P. Morgan organized emergency support from his private library on East 36th Street. Legend says Livermore recognized the exact moment. Panic reached climax and began covering shorts, even reversing long on the strongest names. While amateur traders held losing shorts hoping for more downside, Livermore understood that panic selling creates its own exhaustion. The professional task: recognize the crescendo, exit into it, and prepare for the flip. Understanding panic exhaustion requires recognizing the behavioral patterns of forced selling. Fear doesn't operate on logic, it operates on liquidity constraints. Margin calls force sales regardless of price. Stop losses trigger in cascades. Institutional redemptions create indiscriminate selling pressure. But this forced selling has natural limits. Eventually, weak holders are flushed out. The selling pressure that seemed infinite suddenly encounters genuine buying interest from patient capital. Here's the problem that destroys most profitable short sellers. Most traders overstay the profitable side because greed masquerades as discipline. They confuse holding winning positions with professional behavior. They mistake stubbornness for patience. When you're short and the market keeps falling, every instinct tells you to hold for more. Your brain calculates additional profits if the decline continues. You start believing your own thesis too strongly. You forget that markets move in cycles, not straight lines. Walk through how our Knickerbocker Trust story reaches its climax. The stock plunges from 26.9 to 24.6 inches, violent selling over 30 minutes. Your pyramided short position shows substantial profits. Every tick lower adds to your account balance. Then something fundamental changes in the market's character. Spreads explode wider, not from selling pressure, but from complete bid absence. Down ticks accelerate, then suddenly stall. The tape starts printing erratically. A massive bid flashes at 24.4, gets hit immediately, then reloads at the same price. This isn't normal market making, it's institutional accumulation. Someone with deep pockets is absorbing the panic selling. Volume spikes to 400% of average as this hidden buyer meets desperate sellers. The prints scatter wildly. 24.38, 24.35, 24.42, 24.33. Then, something remarkable happens. A 5-minute hammer candle forms off 24.35, your new pivotal point. This hammer isn't just a technical pattern. It's evidence of a fundamental shift in supply and demand dynamics. The selling that drove the stock from 28.2 to 24.35 has met buying power willing to absorb it. The pivotal point has flipped from resistance to potential support. Your short thesis, which was correct for the past week, may be reaching its expiration date. Protocol for panic exits and reversals begins with covering 50–70% of shorts into volume climax. Don't wait for perfection. When volume explodes to 300 to 400% of average and spreads widen dramatically, the market is telling you that panic has reached extremes. This is your signal to take profits on the majority of your position. Don't try to pick the exact bottom. Exit into the chaos while liquidity exists. Watch for reversal patterns at pivotal points. Hammer candles, outside bars, higher lows after panic lows. These patterns aren't magic. They're visual representations of supply and demand shifts. A hammer shows that selling pressure was absorbed and buying interest emerged. An outside bar demonstrates that both buyers and sellers showed up, but buyers ultimately won the session. Demand confirmation for any long reversal. Take out of pattern high with sustained bids. Narrowing spreads. In our example, the hammer high sits at 24.42. You need to see sustained trade above this level with improving market structure before considering any long position. Spreads should narrow from the wide levels seen during panic. Bids should appear at multiple price levels, not just single large orders. Reverse only small portions initially. 0.25 to 0.5% account risk with stop loss just below the hammer, low. If you decide to go long after being short, your position size should be even smaller than your original short entry. You're fighting recent momentum and betting on a reversal, the lowest probability trade setup. Your stop loss sits just below 24.35. The hammer low. If the pivotal point fails to hold, you want out immediately. Add to reversals only on proof. Higher highs and higher lows, with volume heavy on up bars, light on pullbacks. Don't pyramid into reversals the same way you pyramid into trends. Reversals require more confirmation because you're betting against recent momentum. Wait for clear evidence that buying interest is sustainable, not just a temporary squeeze. Maxim: get paid on the way in and the way out. Panic is a two-way market. Professional traders understand that major moves create opportunities in both directions. The same fear that drives prices down creates oversold conditions that smart money exploits. Your job is to recognize these transitions and position accordingly. This is the paradox professionals understand. You trade fear by being fearless about your rules. Patience on the way down. Controlled aggression only when the tape flips direction. You don't fight the dominant force, you recognize when that force changes direction. Livermore didn't become bullish because he liked stocks. He became bullish because the market structure shifted from distribution to accumulation. This completes the loop we opened in Chapter 1. One bell rings twice. First, at the breakdown confirmation when 28.2 failed with volume and follow-through. Second, at the reversal confirmation when 24.35 held and 24.42 was reclaimed with sustained bids. Both pivotal points connected by the same principle. Let price lead. Follow with discipline. The methodology remains constant, even as market direction reverses. But knowing the system isn't enough. When sirens are wailing and your screen bleeds red, you need a checklist you can execute without thinking. That's what separates the 5% who profit from the 95% who panic. Success in panic isn't intensity, it's order. Professionals don't fight emotions, they sidestep them with process. Livermore's edge wasn't prediction. It was patience, tape reading, and ruthless risk control executed mechanically when markets screamed loudest. While amateur traders thrashed around making emotional decisions, Livermore followed his systematic approach regardless of conditions. Here's your do list. Earn more checklist for when chaos reigns. The complete panic protocol begins with situation scan. Identify the market's pivotal points. Where did defense hold twice or more? Before placing a single trade, map the battlefield. Mark levels where real money made decisions previously. In our Knickerbocker Trust example, 28.2 was defended 3 times before failing. That defense made it significant, not arbitrary technical analysis. Bias from tape, not news. Are bids absorbing, selling, or vanishing? Is volume expanding through key levels? Turn off financial television. Close news websites. Focus entirely on price and volume behavior. When selling pressure hits pivotal points, watch market response. Do bids step up to absorb selling or disappear completely? Does volume surge when levels break or remain anemic? The tape tells you everything about supply and demand dynamics. Entry plan. If level X breaks with 150 to 200% volume surge and 1 to 1.5% follow-through, enter short. Stop loss above last meaningful bounce. Define trigger conditions before panic begins. If 28.2 breaks with volume at 150% of average and follow-through to 27.75, you enter short. Your stop loss sits at 28.45, above the last meaningful bounce to 29.1. These parameters aren't negotiable during market stress. Position sizing. Risk 0.5 to 1% per trade maximum. First unit smallest. Adds even smaller. This destroys most traders. They see opportunity and want to bet big immediately. Professionals start small and earn the right to go larger. Your first entry risks 0.5% of your account. If the market proves you right, you can add. If wrong, damage stays manageable. Pyramiding rule. Add only when recent swing low breaks by 0.75 to 1% on volume confirmation. Trail stops to break even on earlier units. Each add must be smaller than the last. 1. 0R. Base. Then 0. 7R. Then 0. 5R. When you add at 26.65, move your original 28.05 entry to break even. This locks profit while giving new positions room to work. Never add if your last add is underwater. That's hope, not confirmation. Do nothing rule. If tape hesitates, you hesitate. Waiting is a position. Not every breakdown continues immediately. Sometimes selling pressure exhausts temporarily. If volume dries up and the tape starts chopping sideways, don't force additional trades. Patience is your edge, not activity. Professionals sit on their hands while amateurs chase noise. Capitulation watch. Spreads widening. Volume at 300 to 400% average. Hammer. Outside bar patterns at pivotal points. These signal panic reaching extremes. When bid-ask spreads explode and volume surges to 3 or 4 times normal levels, forced selling likely peaks. Look for reversal patterns at key pivotal points. Not guaranteed reversals, but warning signs that easy money may be made. Exit protocol. Cover 50-70% into climax. Reverse small portions only if reversal high breaks with sustained bids. Take profits when panic reaches fever pitch. Don't try picking exact bottoms. If you decide to reverse direction, do so with tiny position sizes and strict stop losses. Reversals are lower probability than trend continuation. Maxims to memorize for high-stress moments. Price is the judge. Volume is the jury. Your risk plan is the sentence. When emotions run high, these phrases anchor decision-making. Price tells you what's happening. Volume tells you significance. Your predetermined risk management keeps you alive. Never average down, ever. This rule has no exceptions during panic conditions. If your position moves against you, your timing or analysis was wrong. Adding to losers compounds errors and destroys accounts. Cut losses fast and wait for better setups. You earn size by being right. You keep it by moving stops. The market rewards accuracy, not aggression. Build position size gradually as the market proves your thesis correct. Protect profits by trailing stops as positions move favorably. Waiting is a position. Doing nothing is often the highest probability trade available. Don't confuse activity with productivity. The market provides opportunities. Your job is recognizing them and acting decisively when they appear. One final loop to close. How do you know you're becoming a professional? Your bad days are small and boring. Your good days look like patience finally rewarded. Amateur traders have dramatic wins and devastating losses. Professionals have consistent, methodical results. That's the 1907 lesson. Crashes aren't invitations to be bold, they're examinations of discipline. The traders who survived 1907 weren't the ones who predicted panic. They were the ones who followed their process regardless of market conditions. They cut losses quickly when wrong. They added to winners systematically when right. They exited into climaxes rather than hoping for more. They treated each trade as part of a larger campaign, not a single battle. Final actionable recap. Cut losses fast. Size small. Wait for confirmation. Add only on proof. Exit into panic. Own your process. These 6 principles will serve you in any market condition. They worked in 1907, 1929, 1987, 2008, and 2020. They'll work in the next panic because human nature doesn't change. If this 1907 panic playbook revealed Livermore's systematic approach to market chaos, the next lesson on building quiet periods between trades will deepen your patience muscle for the inevitable waiting periods between opportunities.